What I find so interesting, Bob, is that you have such low expectations about the economy and the market. And then as time goes by, you see expectations now getting on the opposite end of that spectrum. And along the way, the market continues to grind higher. And I guess so it really seems to me as though that what will really tell us if this tape is for real, I think, is less about the Fed. Maybe we'll get into that right now, is that although that seems to be the story that everyone consistently talks about, it's going to be more about what earnings are going to do next quarter. Because if earnings are not being justified based upon the expectations that are being set, that is something that all index traders and traders have to really keep their eye on, maybe even more so than the Fed.
Yeah, I think that's right. Like the reality is the Fed story on let's say the next 12 months. There's nothing really interesting going on with the Fed. Like the Fed's not going to do much.
Finally, Bob,
Whatever.
finally. It's finally not the big story. Yeah.
It's not. No, I really don't think it's a big story because, like, look, are they going to cut one time this year, two times this year, three times? It doesn't make any difference. Doesn't make any difference to what's going on. With the current state of the economy and inflation, et cetera, they're not going to be hiking interest rates anytime soon. And they're also not going to cut 6 or 8 times, the magnitude of cuts that would be necessary for them to meaningfully, influence asset prices, influence the economy in a material way. And so, in some ways, you sort of like can take that out of the equation as an investor right now, and it really does come down to that real economy and the real outcomes price. I think in some ways the dynamics that are going on right now are the fundamentals are better than where we were obviously back in the 2000 bubble, but some of the dynamics, particularly around the equity price dynamics, are similar in the sense of a continued increases in expectations of earnings that then at some point just don't get hit, which creates a price change in the equities. And so it's not like if you go back to the late 90s and early 2000 period, it's not like growth was particularly bad. In fact, like unemployment only started to meaningfully rise quite a ways after the stock market fell. The way that dynamic worked is that expectations got to be relatively extreme, not really of earnings because a lot of those companies didn't have any earnings, but really around sales and future growth prospects. And then those companies just didn't achieve those future growth prospects, and that created a re-rating of the price, which created the a reinforcing downward dynamic, which then fed through to the real economy. We can have the same sort of dynamic occur. Now, of course, it's not as extreme, but you'd have the same sort of dynamic occur, which is, say, earnings are basically flat over the course, or up in the single digits, in the low to mid single digits over the course of the next 12 to 18 months. If expectations are so elevated, even with modestly, like pretty good, fine earnings growth, if you don't hit those expectations, prices re-rate, and that creates the second and third order consequences. And that's, of course, not to even raise the possibility of the risk that actually we have a more meaningful economic slowdown after years of tight money in place.